As we enter 2026, here are some investment themes that long-term investors should know. The stock market is poised to deliver double-digit returns for the 6th time in 7 years, marking an impressive period that was interrupted only by the inflation-driven decline of 2022. This sustained strength has positioned many investors favorably as they look ahead. While strong returns benefit portfolios and financial goals, they often bring heightened anxiety, particularly with major indices trading near record highs and valuations approaching levels last seen during the dot-com era. However, 2025 brought resolution to several persistent concerns. Inflation has stabilized around 3%, tariffs have caused less economic disruption than anticipated, the Federal Reserve has continued its rate cuts, and economic growth has remained healthy. Most importantly, the recession feared since 2022 never materialized, reminding us that anticipated crises often fail to occur. Looking forward to 2026, investors face questions about midterm elections, Federal Reserve leadership changes, AI's trajectory, and the dollar's path. Success depends less on predicting each development than on maintaining a well-positioned portfolio. Here are 7 themes to guide investment thinking for the year ahead. Diversification is supporting portfolio performance. Multiple asset classes are contributing to returns as 2026 approaches. Contrasting with the past decade U.S. stock dominance, international equities have outpaced domestic markets in 2025, with developed markets and emerging markets each gaining approximately 30% in dollar terms, driven by improved growth expectations and dollar weakness. Fixed income has provided portfolio stability, with the Bloomberg U.S. Aggregate Bond Index gaining 7% as the Federal Reserve cuts rates and inflation stabilizes. Quality bonds have fulfilled their role by generating income and offsetting equity volatility during uncertain periods. This reinforces the value of maintaining diversification rather than making reactive portfolio adjustments based upon headlines. Valuations approach historical extremes. The S&P 500's price-to-earnings ratio of 22.5 times approaches the dot-com peak of 24.5 times, meaning investors are paying premium prices for future earnings. While elevated valuations warranted concern during the dot-com bubble due to disconnection from fundamentals, today's corporate earnings remain robust and are projected to continue growing according to consensus estimates. High valuations don't necessarily predict immediate declines, as markets can remain expensive for extended period. However, they suggest more modest future returns and increased sensitivity to disappointments. Markets that are priced for perfection can experience volatility from minor earnings or economic data misses, making selectivity and balance across asset classes, sectors, and styles increasingly important. AI investment drives economic activity. Artificial intelligence has dominated investor attention as capital expenditures reach trillions of dollars in 2025 for data centers, equipment, and research. Business adoption is accelerating, with Census Bureau data showing AI usage doubling from 4% in September of 2023 to 10% in September of 25, while anticipated usage rose from 6% to 14%. The Magnificent Seven technology companies, representing approximately 1/3 of the S&P 500, continue to lead markets higher through infrastructure investments, and AI tool adoption. This concentration creates both opportunity and vulnerability for portfolios. History shows transformative technologies follow patterns of skepticism, rapid adoption, enthusiasm, and eventual economic integration, though markets often overestimate profit generation speed. Maintaining appropriate asset allocation aligned with long-term goals remains essential given widespread AI exposure. Economic growth has slowed but exceeded fears, with US GDP rebounding to 3.8% in the second quarter of 2025 after a slight first quarter dip. The International Monetary Fund projects global growth easing marginally from 3.2% in 2024 to 3.1% in 2026, with advanced economies at 1.5% and emerging markets above 4%. Growth remains uneven across income groups and sectors, creating a K-shaped economy where technology positioning and financial circumstances determine who benefits. The critical long-term question is whether recent technological advances boost productivity, which averaged only 1.2% annually during the 2010s. Improved productivity could enhance profit margins, supporting broader economic growth and investor returns. Tariff impact remains limited. Despite driving 2025 market volatility and rising to 10 times prior levels, tariffs have shown minimal immediate economic impact. The Consumer Price Index has increased only slightly, likely due to paused or scaled back announcements, companies absorbing cost, advanced importing, and strong offsetting factors including consumer spending and AI sector growth. These developments, including the 2018 trade negotiations, demonstrate that tariffs represent policy tools rather than fundamental shifts. While they won't disappear, their influence on daily market activity may diminish as they become a familiar part of the policy landscape. Political and fiscal concerns dominate 2026. Following 2025's 43-day government shutdown and budget deficit concerns, the One Big Beautiful Bill Act has provided tax clarity. However, the short-term funding bill expiring in January could trigger additional negotiations and potential shutdowns. Midterm elections will draw attention regarding implications for tariffs, regulation, and spending. Though historically these years have delivered healthy average returns since 1933. The national debt exceeding 120% of GDP remains a concern unlikely to be resolved soon. The One Big Beautiful Bill Act could add over $4 trillion to the debt over the next decade. While debt sustainability may affect growth and rates, investing based upon these worries would have historically proven counterproductive. Instead, focus on understanding tax legislation changes and their planning implications, including permanent lower rates, higher estate tax exemptions, and increased SALT deduction caps. Federal Reserve policy evolves. After resuming rate cuts in September, the Fed faces less certain policy direction as focus shifts from inflation concerns to labor market weakness. Fed Chair Jerome Powell's term ends May 15, 2026, with his successor potentially favoring additional cuts to support lower interest rates. The economy has performed well across Fed chairs from both parties, since the Fed only controls short-term rates. Long-term rates depend upon economic growth, inflation, and productivity. Rather than parsing every Fed statement, investors should focus on these longer-term trends to understand their impact on rates and bonds. Entering 2026, investors must balance concerns with the reality that markets have consistently rewarded patience and discipline. History shows that many feared events never materialize, and successful investing depends upon maintaining balance through market cycles rather than predicting which concerns matter most. The bottom line, while strong returns continue, elevated valuations and moderating global growth suggest tempering expectations for 2026. Success comes from maintaining balanced portfolios positioned for various outcomes rather than attempting to time markets based on any single concern.